All right, let's talk about money. Who's really pulling the strings in our economy? Is it the government, the big banks, or is it something, well, a little more complicated? Today, we are diving deep into the supply of money to figure out who is actually in the driver's seat. Let's get into it.
So, first things first, where does money actually come from? Now, if you're imagining some giant government printing press churning out bills, you're not totally wrong. But that's only a tiny piece of the puzzle. The real story, the one that impacts you every single day, it starts somewhere you probably go all the time.
Yup, I'm talking about your local commercial bank. This is where most money is actually born. See, the vast majority of money in our economy isn't physical cash at all. It's digital, and it's created basically out of thin air by banks every single time they make a loan.
Just think about that for a second. When a bank gives you a loan, say for a house or a new business, they don't go into a vault and pull out a big bag of cash. Nope. They just type a few numbers into your account, creating a brand new deposit. And just like that, poof, new money has just been injected into the system. But that's just the beginning. That single act kicks off this incredible ripple effect. Okay, let's walk through it. Say you deposit 1,000 shillings. The bank is required by law to keep a small piece of that, maybe 100 shillings, in reserve. But the other 900, they can loan that out. Now the person who borrows that money spends it, and whoever they pay deposits that 900 shillings into their bank. And what does that second bank do? It holds a small fraction and loans out the rest. This cycle just keeps going and going, multiplying that initial deposit across the entire banking system.
And what we just described, that's what economists call the multiplier effect. It is the fundamental engine of money creation in a modern economy. It means that one single deposit can snowball into a much, much larger increase in the total money supply. So here's the key idea. Commercial banks are not just passive keepers of our money. They are active creators of it.
Okay, so if regular banks are out there creating money with every loan, what's to stop them from just going wild and creating way too much? Well, that's where the core controller comes in. We're talking about the Central Bank of Kenya, the CBK, and they have a powerful toolkit with 3 main levers to manage this whole process.
First up, we've got their most common tool, Open Market Operations, or MO. Now, it sounds super technical, I know, but the idea is actually pretty simple. It's all about the central bank either buying or selling government securities, things like bonds, to either inject money into the banking system or pull it back out. Here's how it works. When the CBK wants to boost the economy, it buys securities from commercial banks. It pays them with fresh cash, which gives those banks more money to lend out, increasing the money supply. And when it wants to cool things down, maybe fight inflation, it does the opposite. It sells securities to the banks, and the banks pay for them, which takes cash out of the system. It is literally the gas and the brake pedal for the economy. All right, tool number 2, reserve requirements. Remember that little fraction of your deposit the bank has to hold on to? Well, this is the rule that sets that amount. The CBK decides the exact percentage, which gives it direct control over how much lending power those banks have and how strong that multiplier effect can be.
And the logic here is really straightforward. If the CBK lowers the requirement, banks suddenly have more money to lend from each deposit. This supercharges the multiplier effect and grows the money supply. But if they raise the requirement, banks have to keep more cash locked away in their vaults, which reduces their lending capacity and shrinks the money supply. Simple cause and effect.
And that brings us to the third big tool in the toolkit, the central bank rate, or the CBR. You can think of the central bank as the bank for banks. It's the lender of last resort. So if a commercial bank needs some short-term cash, it can borrow directly from the CBK. And the CBR, that's the interest rate they get charged.
This single rate really sets the tone for the entire financial world. When the CBK lowers the rate, it becomes cheaper for banks to borrow. That encourages them to lend more money to you and me. But when they raise the CBR, borrowing becomes more expensive for banks, which makes them a bit more cautious about lending. And that slows down the growth of the money supply. So we have the banks creating money and the central bank trying to regulate it all, but it's not quite that neat and tidy. The truth is, this whole system doesn't operate in a vacuum. There are other powerful forces at play, external influences that can mess with the whole equation. For starters, you have government policy. Big spending projects or tax cuts can pour money into the economy. Then there are international money flows, from things like exports and foreign investment. Even our own behavior plays a role. I mean, if everyone decides to pull their money out and hide it under the mattress, banks have less to lend. And maybe the biggest one of all, the demand for loans. If businesses and people just don't want to borrow, it doesn't matter what the central bank does. The money creation machine just sputters.
So let's zoom out and put all these pieces together. What we're really looking at is not some simple machine with a few dials. It is a deeply complex, living system that demands a constant, delicate balancing act. When you get right down to it, the supply of money isn't just one thing. It's a dynamic system. It's this intricate dance between the central bank's deliberate policies, the profit-driven decisions of commercial banks, government actions, global events, and hey, even the choices that we all make every single day.
Which leaves us with a final question to think about. With all of these moving parts, these powerful tools, these unpredictable human factors, is managing an economy's money supply really an exact science? Or is it something a lot more like a delicate and very difficult art? What do you think?